high probability fair value gaps. Come on, man, we're gonna get into it. But beforehand, got a couple things I gotta say to y'all. First of all, I know you see the robe, all praises due. Number two, code sway on Apex Trader Funding. Code sway 80 to 90% off depending on what sales going on. It directly helps me out. So go ahead and use code sway on your future Apex purchases. So I'm gonna just jump right into it, right? What makes a fair value gap high probability? So I've gotten a couple examples for you guys that I'm gonna go ahead and jump into. What makes a fair value gap high probability? So it's multiple things, right? We got to stack the confluences. And the first thing that I want to point out is, where is that fair value gap located? Where the fair value gap appears is so important, obviously, right? Because as you can see here on my chart, I'm on the 5 minute time frame. There's one gap, two gaps, three, four. There's just a ton of fair value gaps here. So which one do we know we want to take our trades based off of? And for me, I use something called premium and discount a lot. I'm sure that y'all are very familiar. So we take 50% of this range. So this white line, this is where it's drawn from the high and from the low. I personally use the candle bodies and not the wicks to get 50% of the range. So in this example, this is a trade that I took. I'm looking to go short, right? I want the market to go down. With that being said, I will only take shorts above 50% of this range because shorts will be in discount. When we're looking for shorts, above 50% is discount, below is premium. You don't want to buy when there's a premium, right? That's like, you know what I mean, going to the store and paying full price when you know that it be on sale the next day. It just doesn't make sense. Up here, you're taking your position when it's on sale. And just to reiterate, so if that was backwards, if we were bullish, we want to buy below 50% of the range and sell above 50% of the range, right? Because then calls are in discount. So this particular fair value gap, I took a trade off of. I shorted off of this gap. As you can see on the 5 minute, use the writing, but as you can see on the 5 minute chart, we did see a nice sell-off, but it wasn't the way that the trend was, which is okay. I was still able to capture 8 points on this move, and I wasn't in line with overall order flow. So the reason why stacking these confluences on high probability fair value gaps helps is because if you choose the right gap, you're going to get a reaction, right? Even if overall your direction was wrong. So as you can see, the market kept going up, but my overall trade idea was correct because we got that sell-off. So number one is premium and discount. Number two, if you are familiar with any of my style of trading, you know I love sway suit. I love when there's a high or equal highs right inside of a fair value gap to get taken. I see that as a ton of liquidity resting, right? Because I know a lot of people are using this fair value gap as resistance. So they have their stop loss right above this high, right above this high. So when price goes and breaks through these highs, multiple things are happening. Their sell stops, their sell orders have buy stop losses. So those stop losses are resting right up here. And it's also a fair value gap, which is an area of liquidity, right? So there's tons of orders resting right above here. Paired with the fact that we're above 50% of the range, this is the first fair value gap at 50% of the range, it adds up for a nice short. So on the 1 minute chart, as you can see, we shorted right up here, and then we got a nice reaction down for a few points, a retrace. That retrace never came back to this high, which is where our stop loss would be, and price just ran to the equal lows. That is because this 5 minute gap is a high probability fair value gap. It was in discount. It had equal highs. It had sway soup. And then also, as you can see, it was partnered with a market structure shift, meaning once we take out this low, we know that the trend has changed, right? We know that now we're looking to go down because before we're making higher lows. All these lows are higher. Now we just made a lower low here. That lets us know even more that this gap is high probability. Of course, it's while we're in the trade, but it's just something for us to hold on to, right? So that's our high probability trade there. Now over on NQ, I have another example of a trade of how I was able to use an inverse gap and why this one in particular was high probability, right? So check this out. I have it labeled all the way. So price came down and we swept some higher time frame liquidity. So this was a higher time frame low that we just took out. So boom, liquidity sweep. It's the first thing that happened. Now, right after that liquidity sweep, as we trade up, we actually start rejecting down close candles. After the liquidity sweep, we get this candle that I like to use. As you can see, price is respecting this candle. That's confluence number 2, that the trend is changing from bearish to bullish. Now, confluence number 3 is that we have a bearish gap. Confluence number 3 is we have a bearish gap and we go ahead and violate it and we close above, which is the inverse fair value gap model, if you're aware. So just in this little group of price, this is like what, probably 10 minutes of price action, because it's the 1 minute. There's 3 things that happen that let me know when we do violate this gap, we're going to go see higher prices. Liquidity sweep. We always need a liquidity sweep for a reversal. Number 2, the money block is being respected. Price is rejecting down close candles, meaning its price is now bullish. And number 3, price is violating bullish fair value gaps. This being the main one. So once we close above this gap right here, we're looking to go long. And that's exactly what we did, right? Our first target is going to be the high inside the fair value gap. Just like I said, this time it didn't reverse price. Just move our stop up. And then also target that second high up there. So this inversion fair value gap is high probability because of the confluences. The money block, the liquidity sweep, and then the fact that we ultimately did inverse that gap. That's exactly what my trade did look like. So almost 3.5 to 1 risk reward ratio on something like this. And I was able to hold all the way up till here just because of my little secret sauce with the standard deviations. If you know, you know. The first standard deviation lines up exactly with the high. And once I saw us reject at that high, I knew that we were gone. So in order to find what fair value gap is the highest probability, stack the confluences, right? Which ones are paired with the liquidity sweep? Which ones are paired with premium or discount of the range? Add all these things together and then stack at least 3, and then you'll figure out which gap you can take, right?